What if I told you that one of the biggest reasons people struggle financially is because they don't understand two simple words, asset and liability? Most people think they know what these words mean. But according to Robert Kiyosaki, even highly educated people often get them wrong, and that misunderstanding can cost them a fortune over a lifetime. Today we're exploring one of the most important lessons from Rich Dad, Poor Dad: why the rich buy assets, while everyone else spends their lives buying liabilities. Rich Dad gave Robert a very simple definition: an asset puts money into your pocket. A liability takes money out of your pocket. That's it. Simple, but powerful. Many financial textbooks define assets and liabilities using accounting terminology. Rich Dad wanted people to understand them in practical terms. If something regularly generates income for you, it is likely an asset. If something constantly costs you money, it is likely a liability. Most people spend their lives earning money and then using that money to buy things: a bigger house, a newer car, expensive gadgets, luxury items, and while those purchases may feel good, they often create ongoing expenses. Mortgage payments, property taxes, insurance, maintenance, interest payments, fuel repairs. Month after month, these expenses pull money out of your pocket. The result? People work harder, earn more, spend more, and remain trapped financially. One of the most controversial statements in Rich Dad, Poor Dad is this: your house is not necessarily an asset. When Kiyosaki first wrote this, many people were shocked. After all, we've been taught that buying a home is one of the smartest financial decisions we can make. But Rich Dad challenged that belief. He argued that if your house requires mortgage payments, maintenance costs, taxes, insurance, and repairs, then it is constantly taking money out of your pocket. In that case, it behaves more like a liability than an asset. Now, Kiyosaki wasn't saying home ownership is always bad. His point was that many people confuse ownership with wealth. Just because you own something doesn't mean it makes you richer. The key question is, does it put money into your pocket or take money out? According to Kiyosaki, wealthy people focus on acquiring assets first. Instead of spending every extra dollar, they buy things that generate income. Examples include rental properties, dividend-paying stocks, businesses, royalties from books or intellectual property, investments that produce cash flow. Each asset creates a small stream of income. Over time, those streams grow. Eventually, the income generated by assets can exceed living expenses. That is when financial freedom becomes possible. Let's imagine two people. Person A receives a salary increase. He immediately upgrades his car and moves into a larger house. His expenses rise, his debt rises, his lifestyle rises, but his financial freedom does not. Person B receives the same raise. Instead of increasing spending, she buys investments that generate income. Those investments begin producing cash flow. Over time, the income compounds. Years later, Person B owns assets that continue generating money even while sleeping. The difference isn't income, the difference is what happens after the paycheck arrives. One of Rich Dad's most important ideas is to pay yourself first. Most people receive a paycheck and immediately pay everyone else: the mortgage company, the bank, the credit card company, the utility company. Then they save whatever remains, usually very little. Rich Dad taught the opposite approach. Take a portion of your income and use it to acquire assets first. Make building wealth a priority, not an afterthought. Kiyosaki often talks about building your asset column. Imagine your financial life as a balance sheet. Every time you buy an income-producing asset, you add another brick to your financial foundation. The bigger your asset column becomes, the more financial security you create. Eventually, your assets begin working harder than you do. That's when money starts working for you instead of the other way around. Most people spend years trying to earn more money. Rich Dad believed the better question is, what are you doing with the money you already earn? Every financial decision either moves you closer to freedom or further away from it. The wealthy focus on buying assets. Everyone else focuses on buying things that look wealthy. And there is a huge difference. In part 4, we'll explore another powerful concept from Rich Dad, Poor Dad: why Rich Dad said, mind your own business, even if you already have a full-time job. If you enjoyed this summary, subscribe to Wealth Wisdom Strength for more lessons from the world's greatest books on wealth, success, and personal growth. Remember, read less, learn more, grow faster.